Welcome everybody to our webinar today entitled How Managing Your Supply Chain Drives Value in M&A Transactions. We've been looking forward to having a strategic conversation with an expert in this area as part of our stream, and we're very pleased and excited to welcome Farzad Mukhi, who's Managing Director at Kroll, to talk about this. Quick thing about Farzad, who will be joined by Bill Michalski, our Chief Product Officer. Farzad is a managing director in the LA office. He's a member of the firm's food and beverage M&A practice. He's with over 17 years of experience in every kind of M&A and corporate finance transaction. He's seen it all. So you're going to hear from him about how to think about the valuation pieces, what really affects your business. It's really meant to be a lot of value for folks who are in the restaurant space, especially as they think about the SPACs and IPOs and everything that's going on. So you'll hear it from Farzad. Joining him is our very own Bill Michalski. Bill is a Chief Product Officer from Aristream, very deeply involved with the industry for quite a few years. And he will provide a perspective to us on the execution pieces of this. One part is to identify what needs to be done. Second part is to say, how do we make it happen? So Bill is going to be joining me and talking about all of that. Well, with that, we're going to hand it off without further ado to Farzad. Farzad, give me a second while I make you the presenter and you can take it away.
Great, thanks, Raj, and I'm really excited to be here and talk about this with you. Really quick before I dive into the data and the information and the meat of the business, I'd just like to provide a little more overview on our firm and our M&A practice. So first of all, Kroll as a firm is about 5,000 people in 30 countries. We serve as a crucial partner to businesses with regards to value, risk, and governance. My practice is the one highlighted in green, that's corporate finance. But aside from what I do, we have professionals across the world in valuation services, compliance, cybersecurity, business services, and other types of really crucial types of solutions to mid and large size businesses. Within our M&A practice, we're about maybe 400 people around the world. Our practice is focused on advising middle market businesses in executing transactions, primarily sale transactions, as well as capital raising transactions. We're very sort of hands-on and focused on really companies that either have family ownership or privately held ownership. I think that's where we excel and where we differentiate ourselves in the market. Happy to answer any questions later on our practice, but before doing that, I can give you all a quick overview on what we're seeing in terms of the M&A market. I think there's been a real sort of revival in activity across M&A in all sectors, and one of the main drivers of that is the additional liquidity that's in the market today. And I think that's exemplified by this first exhibit here that tracks the cash balances that are being held among the largest U.S. corporations across all sectors. You could see that between 2020 and 2021, there's a pretty material increase, about 1.1 trillion additional in cash that's on strategic balance sheets that many are using for M&A. They're restricted a lot of times in stock buybacks and are looking to drive further growth. And so M&A is a great way to do that and a great way to utilize this cash for a good return. Beyond strategics, we're seeing a lot of activity among private equity funds. They saw a bit of a downturn in terms of M&A activity in 2020 because of the market overall and some of the challenges in executing transactions in a shutdown and in a challenged environment. But their activities more than made up for in 2021, where we haven't just seen them as active participants and acquirers in our transactions, but they've also gone out and raised additional capital to go deploy over the next 5 to 10 years. So private equity is oftentimes outbidding strategics in some of our sell side transactions, and they're really being fueled by the credit market. So, this chart here displays the amount of debt capital that's being raised to fund acquisitions, particularly by private equity funds. And you're seeing that there's a pretty strong uptick in terms of the amount of debt available to fund acquisitions between 2020 and 2021. And in fact, it's at a higher level than it's been in the past, call it 9 years. And I think what that translates to is the ability for private equity funds to pay a higher multiple for businesses that they like. And this sort of translates, this exhibit translates to middle market M&A purchase price multiples across all sectors. So, we're not quite back at valuations in 2018 and 2019, again, for categories that are outside of restaurants and food and beverage. But you are seeing that multiples are still at pretty elevated levels. So those are all of the positive trends and all the tailwinds in the M&A markets. But frankly, as we're sitting here today, there are a couple of areas that I think are beginning to challenge the market in terms of activity and valuation, and I think will continue to for the coming months and maybe year or so. First of all, inflation. I think everyone on the phone has either seen inflation as a consumer or as an operator of a business. It's intensified over recent months. We're going to talk about it in more detail later, but frankly, it's been exacerbated by a lot of categories, and it's led to business owners and potential buyers, really starting to hone in on the risks relating to inflation and ways that inflationary pressure can be mitigated. And I think that as we talk a little more about supply chain and supply chain strategies, I think that's a crucial way to mitigate inflationary pressure. Beyond that, there are increasing interest rates. We're all sort of waiting here today to hear what the Fed will do. But the expectation is that there will be several rate hikes this year, and what that's going to do is that's going to make debt capital more expensive. It's going to make borrowing more expensive. It may take some of the liquidity in the markets that you're seeing out, and so that may translate to a little more pressure in terms of valuations. But what I don't think it'll do is pause M&A activity. I think there's still a robust market among buyers and sellers that's going to continue to transact in this environment. At a high level, just this page talks about M&A activity, and it tracks two categories that are relevant to our discussion today. The first is food and beverage, and that's the top chart here. I think of food and beverage as brands, processors, distributors in the category. The bottom chart is restaurants, so very much food service. So what you saw here, and what I think is really interesting, is the second quarter, and we checked that this data is correct. It happens to be the same number, but in the second quarter of 2020, we saw a significant dip in M&A transactions because of the uncertainty and some of the challenges in executing transactions. If you look at these two categories, though, you're seeing a much faster rebound in food and beverage than we've seen in restaurants. The food and beverage, M&A volume really got back to a normalized level in Q3 and Q4 of 2020 and has sort of stayed at that level, since then. Within restaurants, there was a rebound in activity in Q3, but it hasn't quite gone back up to the volume that we saw in 2019. I think there are a couple factors beyond that or that underlie that. One is that with some of the challenges of the pandemic, unfortunately, some concepts and some units were just taken out of the system of a lot of these brands. And also, I think restaurants have had their own unique challenges in terms of local lockdown restrictions, labor price increases and lack of availability. So I think the headwinds, particularly for restaurants, have continued a little further along than what we saw in the broader food and beverage category. Within restaurants, I think it's important to just get a better sense for how some of the concept categories have performed. So what we've done here is broken out the public companies into segments based on their service offering and looked at revenue growth and profitability growth. And on this upper left chart, you see 2021. A lot of the growth here in revenue or the categories that grew fastest were fine dining and coffee and sort of breakfast concepts. Within fine dining, I think this is more of a rebound from a very, very challenged 2020. I don't think these concepts have seen the best same-store sales growth over a long period of time. But within coffee and breakfast, I think some of this was driven by a return to people getting back to either the office or just routines and wanting to have breakfast outside of their homes. And then within quick service, this is a pretty similar number to what we saw in 2020. For this coming year, analysts expect that all categories will see strong same-store sales growth, but interestingly enough, the fastest growing categories will continue to be fine dining and coffee and breakfast. I think that's really interesting in thinking about where consumers are choosing to spend their money. In fine dining, I think some of this is relating to more experiential, more sort of splurging in terms of their dining occasions. And in coffee and breakfast, I think this has to do with just continued, return to office.
Prasad, I think
It
what's
has,
interesting, what you're saying here, right, is I think consumers are spending time on, the shortest and the longest, it looks like, right? I want to grab a coffee and go, and I want to sit down for a fine dining. So it's kind of interesting how the bookends are showing up.
yeah, I think that's a good point, Raj. So on the left is sort of convenience, and on the right is sort of experience. And I think consumers are making time for both sorts of experiences. Interestingly enough, the bottom chart tracks profitability. So revenue growth has not really aligned with profitability improvement. 2021 fast casual saw the biggest improvement in terms of profitability, and I think that's because of some of the unique challenges that there were in that sector, some of which had to do with maybe an oversupply of locations before the pandemic. And so as a lot of these concepts have sort of honed in on the right number of units, the right sort of head count at a front office, I think some of that's what's translating to improved profitability. And quick service with given sort of the smaller boxes, I think revenue very much translates to profitability in that category. And then going forward, there's some outliers here that are driving coffee and breakfast higher, but I think there will be profitability improvements there, and also in fast casual. Not so much in some of these other categories. I mean, there will be improvement, but they're being outpaced by some of these other more limited service type of concepts. It's interesting on this page to take a look at public market activity. We saw with SPACs and IPOs that there was a really big rebound in activity in 2021, not just in the restaurant space, not just in the food and beverage space, but in all categories. And a lot of that had to do with growth in a lot of retail investors, channeling their liquidity into the public markets. And a lot of these concepts that went public in 2021 were sort of poised to do so for some time, and I think really capitalized on greater investor appetite, pardon the pun, in restaurant concepts. But I think what we're seeing today is that because of some of the volatility in the public market in year to date in 2022, a lot of concepts have sort of prepared to go public but haven't quite pulled the trigger. They want to see a little more consistency in terms of the markets, a little less volatility. But there are additional concepts poised to go public. On the SPAC side, there has been a lot of capital raised, even just last year, 136 billion. That needs to be deployed in the next 2 years, or else it has to go back to their investors. So you're going to see a lot more aggressive activity. I think the challenge that a lot of these SPACs are seeing is that there aren't a lot more sort of mid to large size concepts in the restaurant space or operators in the food and beverage space that haven't quite gone public yet. So there's a limited supply there. It's either going to lead to overvaluation of attractive assets, or some of these SPACs just have to give back their money that's been raised. Page 10 is an interesting snapshot of just valuations in the public market. So this again tracks, categories. At the top, we're looking at restaurants. At the bottom, food and beverage brands and operators. And I think a rule of thumb around valuation is that growth and profitability drive higher multiples, and you're seeing that definitely in the coffee, breakfast, and snacks category. It's a concept category that is higher margin than other limited service or fine dining type of concepts, and it's seeing more growth. And so public market investors are willing to pay a premium for the stock of concepts in that category. Think like the Starbuckses and those types of concepts. But I would say regardless, valuations even for mass casual fine dining are at if not historic highs, then near historic highs. I think that's reflective of, again, retail investors, liking the category and driving valuations higher. In food and beverage, you are seeing a little bit more diversity in terms of the multiples that these public companies are being valued at. On the left-hand side, you'll see alcohol and non-alcoholic beverage. I think the reason those trade at higher multiples is because they are inherently higher margin businesses. If you look at alcohol and non-alcoholic beverage, those are 30 to 40% EBITDA margin type businesses. So there's much more cash flow that's yielded for those businesses, and so investors are willing to pay more for a stock like that. On the bottom end of the spectrum, there's protein processors, which are a category that's very much exposed to commodity prices, and a category that's been challenged from a labor perspective, and even a trend away from eating plant-based protein. So I think that's what's driving that category lower in particular. But interestingly enough, if you look at the median across all of these public businesses, they're not that different between restaurants and food and beverage at 13 times EBITDA for restaurants and 12 and a half times, call it, EBITDA for food and beverage companies. Um, Switching gears a bit, I think the underlying headwind that I touched on really is inflation and supply chain, and I feel like personally myself and for our clients over the past, call it 2+ years, it's just a never-ending challenge among pressures around the supply chain. Initially it was COVID and shutdowns. There was pretty quickly a lack of cold storage space that we were hearing from our clients. Freight was challenged because of a lack of truck drivers. That hasn't changed. That's still a challenge today. It's with the Amazons of the world paying much higher for delivery and for drivers. We're still not, our clients still haven't been able to fill most of the positions that they have for truckers. Most recently, there is the pressures from Ukraine, and I think that's going to manifest itself mostly in wheat and in protein prices, and some of the challenges that are going to come out of the lack of supply and availability on a global perspective. And then lastly, I think the port situation, particularly here where I am in LA and Long Beach, is a little better than it was in the fourth quarter of last year, but it still has not gotten back anywhere in terms of normal pre-pandemic, whether it's time to get through the ports or just the cost to get containers out of the dock. So again, a lot of these challenges haven't gone away. Some of them are just coming up, and what it's doing is it's leading to folks like us having to tell really nuanced stories around businesses and how they can mitigate some of these pressures or when some of them may improve. And so I think that sort of brings us to the topic of our webinar today, which is really how to mitigate some of these pressures, whether it's operationally or whether it's more positioning with regards to M&A transactions. We're seeing buyers, whether they're strategic and more so private equity, being a lot more sophisticated in terms of diligencing our clients and how they can mitigate pressures in their supply chain, or even position their supply chains to help them grow. So if you think about a restaurant concept that's maybe hyper regional today, we often get questions when we market those types of businesses around, how can they scale, not just from a location perspective, but in terms of servicing those locations. So I think there are a lot of ways that our clients, whether it's during our processes or before, can hone in on those questions and really create value. So some of the common themes we see with our clients where supply chain is a value driver is when you've got a diverse supplier base. It's easier said than done for a lot of smaller businesses, but really having that sort of secondary supply and a real supply strategy that's regionally focused, I think is a way to quickly head off concerns around where your ingredients are coming from. Um, Headcount and efficiency is also really important. I think supply chain departments and ingredient buyer departments could be really large, and we've worked with a lot of companies that have had probably more headcount than needed in that department. So I think being really efficient around the overhead costs and the fixed spend, whether it's with labor or other sort of enablers, I think is a way to not just improve profitability, but also show that show that a value can be that is a value driver.
Prasad,
Yeah, but
one question for you on the headcount question, right? Is it your experience that the default reaction to solving problems in this particular sector has been to take a very operational view versus a technology leverage view, right? And if so, what is better from a valuation perspective, right? I'm maybe teeing it up for you, but I'm kind of curious to see how you think about this, when you advise customers.
Yeah, I mean, in the middle market, we often see business owners and folks in those departments add additional people when they can't manage its supply and ingredients themselves. So it's been more oriented towards human capital than technology. But I think that's an opportunity, right? I think the more efficiency you can have that in that department, but doing it with strong execution, I think is a way to point to the fact that this is a problem that's been solved. This is translating to efficiency. It's translating to higher profitability. I think that's very well received among potential buyers.
One of the nuances I think that we see on the ground working with a lot of chains is that we're coming out of a period of time in 2020 when they were constrained in terms of team personnel. They had, a lot of them shed personnel, and the ones who were left were spending all day firefighting. So whereas their jobs might have had a split between category management to improve profitability and just pure supply chain execution, it was all supply chain execution all day long. And we saw that even in usage of our tool sets, where it swung dramatically toward inventory management. It was kind of get the product there at any cost to make sure we keep our restaurants open. So I imagine that had some impact on overall profitability levels that were probably driving some of the graphs earlier. But I think as we move forward, even though the nature of the problem has changed, I think if you talk to most of them, many of them are still in that firefighting mode because of this constant barrage of new disruptions. And so it's kind of this double-edged sword of, you want to improve your profitability by being efficient with your headcount, but also make sure that headcount is enabled to focus on strategic matters and not just spend all day on the phone with suppliers hunting down product.
Yeah,
Great point,
yeah, and
Bill.
I think for concepts we've worked with where they maybe didn't have the right systems or technology, it sort of led to some of these areas of concern manifesting themselves. So issues with consistency, the inability to really diligence your suppliers, and oftentimes having to manage low fill rates just because you don't have qualified backup suppliers. So it's really painful to see our clients take menu items off, but off of their menu. But a lot of them have had to do that, right? And it was just because some of these items that that are necessary just weren't able to be done in a period where you didn't have sufficient staff. And a lot of that translated to this point here, which is weaker profitability, right? It's our hardest job as bankers and as advocates for concepts is to explain periods where profitability was low. We have tools to do that. We can work with accountants and we can work with others, but suffice it to say, limiting those periods of weak profitability will help in terms of valuation, right? It just helps buyers get comfortable that the operations are strong and that the concept is strong, and so anything that can be done to improve profitability and minimize the disruptions that drive weaker profitability are very much value drivers in M&A transactions. I'll just touch on a couple more of these. Quality and certifications and approval processes. Having a very strict way of approving suppliers and vendors is important. I don't think you need to have a 3-year process like you see in the food and beverage space, but something where you can stand behind your vendors. You can sort of, have some trust in what's being provided, I think is really crucial. And, that often mitigates recalls or the potential for recalls or the potential for, products or items that shouldn't have been on menus. And the last one I think that's really interesting is traceability. And some of that has improved as you've seen blockchain technology. But, as quickly as you can hone in on where there may have been issues within a supply chain, the better that buyers will feel about your ability to just control everything, from the farm, even if you're not physically doing that yourself. So you're mitigating recalls, you're mitigating noise like we saw with Chipotle. That means having really good partners in terms of suppliers, but also just having the technology, having the sophistication to be able to trace products back to their sources.
Makes perfect sense.
Yeah.
Thank you, Prasad. So let me take back the sharing real quickly here, and I will invite Bill to talk a little bit about this as well. So Bill, if you want to talk a little bit about resiliency and tied to what Prasad just said as well.
Yeah, it's kind of the other side of the coin in a way, is looking at this through I think the lens of what's been happening the last couple of years. I mean, for those who are not in the industry or not in supply chain, everybody knows about supply chain now at a deeper level than they ever thought they would, because of what's happened in the last couple of years. So it's raised the profile of the importance of managing it well. I also think it's been a bit of a laboratory, really, the last couple of years, where you can watch companies handle this well and be challenged by it. You have a lot of chains who thrived during this environment, despite having to transition in 2 months from not having a takeout business to suddenly having one. The degree of flexibility and access to data and rapid decision making that's required to accomplish something like that is remarkable, and a lot of chains pulled it off to their benefit and were able to stay open. So I think the world is now looking at supply chain through a slightly different lens. I think prior to this, often when people considered supply chain beyond it being a cost function, as more of a brand protection or more of kind of an existentially important function, it was about food safety, right? Are we going to have an event that would materially damage our brand? Well, I think now we see that it's not just food safety, that there are world events that can occur where if your supply chain's not ready, it can shut down restaurants. So what the question that begs is, what are the companies doing that are able to thrive in that kind of an environment? And I think we've talked a lot about, I guess, what I call planned resiliency efforts. So diversifying your supply base, making sure you have the right quality standards set up. I think there are a few others, around just kind of how your network is organized from a logistics standpoint. Do you have a certain level of fluidity? What are your strategies for price protection in terms of your contracting? But I think beyond that, there's also, because there are a lot of companies who had those in place who also struggled mightily during some of these events. And so I think the questions above that, or what I've seen, is that you need to set up your supply chain team to have a capacity to handle rapid change, which means they have to have the time to be able to devote to both handling that firefighting that we talked about, and also managing the company through, and not just their own company, but their network of partners through some fundamental changes. And that really gets, a lot of that gets to having the right data and visibility, uh, because what a lot of teams wind up spending a lot of time on, if they don't have it, is data wrangling. A lot of supply chain teams are basically staffed with a lot of data wranglers if they don't have the information flowing at them in a clean way. But it also gets to just institutionalized processes, right? You have a well-oiled sourcing process that you can lean on when you need to find a new supplier, when you need to ensure that you're paying a fair market price, right? Or overcoming some of the issues with price inflation. Do you have good access to industry intelligence? Yeah, go ahead, Rod.
I guess one question to the both of you, right, is we had an event recently last week in Atlanta, and we met a whole bunch of fairly strategic supply chain officers, right? And one thing that was a consensus among all of them is that, look, it's never going to come back to what we defined normal to be, right? I think it's very clear that what you guys just said, right? The rolling set of hits that keep coming, right? Whether that is the post-pandemic, whether it's the Ukraine war, whatever that is, right? Will basically have permanently transformed this landscape. So both, let's say, Farzad, from your perspective, right? What does new normal look from a valuation and M&A standpoint for you, right? As you think about it, and then maybe Bill, you can chime in with what are customers thinking about doing today, right, in terms of addressing that new normal, right? Is there one? Do you agree with that, first of all?
Yeah, I mean, I agree with that, and I think it's really flexibility, right? A lot of concepts were founded and created with one recipe, one contract manufacturer, one supplier, and I think having to have that backup, like Bill you talked about, and that's going to be really crucial, and it's going to mean having to go out and qualify folks, and maybe even having some, I don't know, flexibility in recipes where you can, but I think flexibility is key, and that's really difficult for a lot of larger chains that maybe haven't had to think about sort of managing their supply chain that way.
Hmm. Yeah, I mean, I'll give the same answer in terms of the new normal. I think absolutely. I mean, if you ask anyone if they think that there's not going to be some other disruption between now and the end of the year that we haven't thought of yet, most people would say yes at this point. So it's the nature of the world. So supply chains have to be built to handle it. What I'm seeing is that there's always been an evolutionary curve when it comes to restaurant chains as they grow, becoming more sophisticated in their management of supply chain. I mean, usually you're moving from a starting point of being very dependent on basically all your partners to act as they should, accomplish things that they're hired to do. I think then you have an evolution into more of a reactive mode where you have good data flowing in, so you can recognize when things are going on and start working with those partners. Where then you pushes into proactive, and that's really where you're trying to orchestrate your supply chain. And you see that a lot today there, and we see it with companies needing to look further and further back up the supply chain to understand what's going on in the supplier plant to get ahead of a potential supply issue that might be 4 weeks down the line. They never would have thought of that before. So I think what you're seeing is that the comparison of that evolution to the growth curve of chains is moving, where smaller and smaller chains are having to get more and more sophisticated
Yeah.
in their management of the supply chain.
Actually, so that ties to what Farzad just said. So Farzad, so when you look at valuation and so on, you almost are um, you're looking at individual sort of players in the value chain, and in terms of what you've seen historically, and making a forecast, intelligent forecast on where they can be. Is there a
Mhm.
premium you assign to collaboration? Meaning, are companies fundamentally more valuable because, to Bill's point, they reach deeper within the supply chain and get a better sense of predictability, right? Is there a premium attached to that? How does it show up as you look at the valuation, right? Is it worth doing that?
Yeah. I mean, I think at the highest level, it shows up in a income statement when you don't see disruption affecting your margins, right? So I think that's the easiest way to see that. I would caution though against being too in depth with a single supplier, right? I mean, I think it's good to have a strong relationship and a lot of visibility, but ideally you can have that relationship with multiple suppliers of the same product. It means having to share your recipe at sometimes with multiple folks. If you're looking at let's say a protein processor that maybe part cooking some meat for you. But I think at the end of the day, having that sort of those multiple relationships is important. The other sort of area of value, which we haven't really talked about, because I think a lot of what we talked about is managing negative disruptions. But I think the ability to launch innovation and new menu items is really important. And you saw that a lot over the past couple of years as consumers change how they ate and where they where they ate. It was fried chicken a couple of years ago. It's more plant-based proteins. But I think having to stay on trend with how consumers are eating is really important, and a lot of that has to do with making sure you can get the products where you need them at the right quality. And so I think that's another value driver. How successful have new menu innovations been? How many of them have stuck around? I think that's a lot of that has to do with how and how effectively you buy and formulate new items.
I think that's a fantastic point. I mean, the promotional activity, limited time offers tended to slow down a little bit during the pandemic, but
Hmm.
I mean they've long been a lifeblood for this industry, but they come with risk.
Right.
Anytime you're introducing a new menu item, or even just changing the way that you're promoting an existing one, so it requires process controls, requires visibility, requires predictability of demand that you can then filter through your supply chain to make sure everybody's operating correctly. So it's not easy to accomplish, and there are teams that do it very, very well, and teams that struggle with it.
So I think
Yeah.
it's a good segue to this other question that came in, right? Which is, are we entering a period where the differentiation is moving to the front end, meaning it's the what you guys are talking about, new menu items, new ways of serving customers, and supply chain is becoming, or should become, a lot more of a standardized view, meaning, are we ready to say that you probably are going to get much better impact by accepting a degree of visibility on the supply chain side, which traditionally was guarded as your secret sauce and differentiation, given the fact that differentiation is really moving on the front end of more downstream towards a customer, right? Would you say that that is happening right now for Zad in terms of how you look at this?
Yeah. I mean, I I think not every concept is the same, right? I think having to spend the time and effort into your supply is going to be more important for cost. So just we talked about coffee a lot, right, earlier on the presentation.
Mhm.
Coffee is a category that's got an incredible amount of commodity price risk, a credible amount of availability, and it's a category that I think a lot of people are tracking in terms of where there is a limited supply coming based on this most recent harvest, and you're going to have to manage those prices. So, I think experience is important to the first part of your question, right? We saw earlier that, people are willing to pay for convenience and they're willing to pay for experience, but at the same time, you've got to be able to give them that same experience when it comes to the product. So, I think if it's something even as simple as coffee, it's got to taste the same. It's got to be available everywhere, and it's got to be affordable. So I think experience is very much tied into the product and the product consistency.
Yeah, it's a really interesting question, Raj. I think the way that I would answer it is that I don't think that any chain wants to give up on differentiation. So they want to maintain their brand reputation, their flavor profiles. They want to be unique. But I think there's a growing realization that that does not equate to hoarding data or hoarding information. That the supply chain can be much more effective and still high quality with a greater degree of transparency and data sharing. And I think you're seeing it happen up and down the supply chain.
Yeah, and
Even
that's
more on that, sorry, on that last point, even more so now as prices have gone up, right? Because a lot of suppliers have had to take price increases, and a lot of that has to do with sharing information, which hasn't really been done as readily before. But concepts are asking for input price information, and so I've seen with a lot of our clients, whether it's processors of food or concepts, that there is a lot more visibility in terms of pricing, and maybe that means that pricing across systems will get a little more consistent, just because of the profit that's being added on to input costs may face pressure. But I think that's some efficiency, but at the same time, you can still use relationships. You can use unique products as a way to command a higher margin if you're a producer.
No, that makes a lot of sense. Thank you. So I think I'm going to move to the final part here. So Bill, maybe you can talk about what Farzad was mentioning about visibility into just getting a sense to folks on what Arrowstream does as well at the top level.
Sure. The common thread for a lot of what we've been discussing is an ability to maneuver in your supply chain based on good data. And for anyone who's in this industry knows that it's a highly fragmented industry from a data standpoint. A lot of challenges to work through, and it's improving, it's progressing, but doesn't necessarily have the level of data quality flowing and data visibility flowing throughout that other industries do. So what Arrowstream does foundationally to what we do is collect information from throughout the supply chain and blend it into a single source of truth for any given party. And that may be the restaurant chain, and maybe the distributor, maybe the supplier, because a key element of this, as I discussed, is data sharing. It's getting everybody on the same page so you can make decisions, because ultimately maintaining these supply chains is a group effort where you're relying on your partners. So we surface all that information in a series of applications then that we use to highlight insights for what's going on. So you don't want to necessarily be spending all day mining the data, even if it's clean. You'd like those insights to be presented to you. Where am I about to run out of stock? Where have I got some pricing issues? Where are some opportunities to rationalize my my SKUs, the products I'm buying, or find some competitive leverage? That's what we're assisting customers do every day. We dig into the quality arena as well, utilizing this network of companies to get to quick resolution when quality issues do occur, and awareness of trends. So we really focus on those elements of making sure we are giving these teams the time to do strategic work, and that we are making them aware of issues that are happening and able to get on top of them.
Awesome. Thank you, Bill. With that, I think we'd like to see if there's any other straggling questions. We got a few that came in already. So thank you, Farzad and Bill, for walking us through this. If there aren't any over here, I think we should possibly get to lunch as my system is reminding me. But thanks for everyone who's joining the session today. Don't forget that our next webinar is on April 27th. And the topic is almost like a part 2 of this session, right? Which is all about the impact of global politics on commodity prices and supply chains. And really, we're going to walk through a couple of case studies of preparation and are you prepared to work with that. Well, thanks everybody. Thank you, Farzad. Thank you, Bill. And hopefully all of you guys have a wonderful day, and I look forward to hearing from you guys soon. Take care. Thank you.
Great.
Thank
Thanks,
you.
everyone.